There's CPI and PPI, retail sales. Let's bring in Dubravko Lakos, he of JPMorgan, joining us once again. It's good to have you back. It's nice to see you. I'm curious your thoughts as you're watching all this unfold today.
Look, one thing I'll say is that when you have such a sharp increase in cost of capital, the unknown of unknowns, the risk of unknown and unknowns, I think, is the highest since GFC. And so I think today what you're sort of seeing with regional banks, what you're sort of seeing on the crypto side, that's just one of the potential side effects, or one of the casualties potential that we're basically seeing, and we don't know what we're in for. So bottom line, to me, what's happening today is not entirely surprising because we are in a very restrictive environment. And so that's the tricky part. And valuation by itself on the equity side is far from attractive. It's unattractive.
Do you worry that these, what may be to some one-offs? I mentioned Silicon Valley Bank, obviously. That's the stock of the moment that we're watching so critically today. Do you worry that these are canary in coal mine moments?
Yes, I do worry. Yes, I do worry. And I think it's not just regionals, but you have the commercial real estate complex, CNBC. You have the leveraged loan world, which is very much so floating, unhedged. And you're starting to see delinquencies in certain parts of the consumer complex, like the subprime auto, multi-loan purpose market. So you're definitely seeing signs that are pointing in the wrong direction. And so if inflation and interest rates and cost of capital don't come down, and right now the trajectory seems to suggest they won't, things are getting uglier.
I mean, you were already writing about this heading into this interview, but long before we were witnessing what we are within the small cap complex, the effect that the rising cost of capital is going to ultimately have on corporate earnings and the cracks in the corporates that are showing up at this point to you.
Yes, you do. I mean, look, many people initially focus on S&P on large caps, where I think balance sheets for the most part are in decent shape. You got 90% of outstanding debt fixed. But to your point, the issue is as you move down the cap spectrum, small, mid cap, you're looking at 30, 45% of outstanding debt being floating. And that's when you start to see sensitivities really pick up if rates and if cost of capital stays elevated. So that's definitely one area that we should be paying close attention to. And even on the back of this recent 4Q earnings release, a lot of small cap companies have been talking about interest expense burden rising and pressuring their margins, right? And I don't think that's getting enough attention.
How defensive do you think people should be right now in their portfolios?
I think you got to be defensive. I think you have to generally have a preference for high quality versus low quality. I know that year to date there's been a big sort of run up and squeeze into sort of junk, unprofitable, high beta complex. That's the area that I think you got to be very careful of. So I'd be very much so leaning towards high quality, good balance sheets, profitable businesses that can withstand these kind of shocks and elevated cost of capital. And anything that's sort of higher beta or borderline unprofitable, I would be cautious.